Welcome to the KingsCrowd Startup Investing Podcast, the podcast that keeps you in tune to what's going on in the online private markets and how everyone can become a startup investor. I'm your host, Sean O'Reilly, and my guest today is Managing Director of Startup Research and Recommendation Service Early Investing, Mr. Andy Gordon. Andy, welcome back to the show.
Well, thank you, Sean. It's great to be here again.
And so we got to kick off the show not with talking about startups or regulation crowdfunding or anything, but with a hearty congratulations to you for welcoming your first grandchild.
Finally, Sean, right?
Finally.
I'm not getting any younger. And it finally happened. My first grandson was born yesterday, Samuel Edward.
And they're down in Atlanta, Rachel. You were telling me? They're down in Atlanta, you were telling me?
Down in Atlanta, yeah. So they're far away from where I am in Baltimore.
What are you doing on the show? You need to get in the car and...
We're waiting for an invite. It should come in. If not today, tomorrow, we're going to find out.
Go meet your grandson and give him a baseball and a mitt or something. I don't
know. Well, we had FaceTime with Samuel yesterday. I thought I saw.
Was he chatty?
No, he was adorable. He was sleeping. His eyes were closed, but he's really cute, and I could tell already that he's a smart kid. Yeah.
Awesome. Yeah, no, you can definitely tell about 18 hours into it for sure. My daughter was born 7 months ago, and I was like, you're going to be smart.
So I'm figuring, Sean, and maybe you can correct me, but I think I can give him his first tennis lesson in about 3 years.
3 years. That is, when did, I know it's golf, but when did Tiger start golfing? His dad had him hitting like at 3 or something, right?
I think I had around that age. Listen, anything. Skiing, golf, tennis, you want to start at around the age of 3. I think Jason Tatum, the all-star forward for the Celtics, he started, you could see pictures of him at age 2, and he has a basketball,
But he's 2, so what is he? Is he just like sitting on top of it? Because the basketball has got some...
with him and, trying to lick it and things like that. But he was 2. Yeah, you have to start him early. So.
Gotta hook him young, yeah. Well, again, congratulations.
Thank you.
Finally.
Appreciate it.
Very, very big deal. Does he have your eyes, chin, anything?
Well, this is going to be the ongoing debate, between, the parents of my daughter and the parents of my daughter's husband, who exactly this kid takes after. The father, the mother, which set of grandparents, we'll see. We'll battle it out.
Naturally. No, because you got 4 people, and then those 4 people have recessive genes. So there's all kinds of crazy combinations. So, yeah. So putting genetics behind us.
If we must, I can talk all day about this, but I guess we should go.
I'm sure you guys are excited. This is really, really cool. But something else very big happened this week, maybe in honor of your grandson. We'll never know. But this past Monday, so we're recording on Friday, March 19th, this past Monday, March 15th, the SEC increased regulation crowdfunding, Reg CF, as we call it. Their max raise limit was increased from $1 million, actually $1.07 million, but who's counting? To not 2 million, not 3 million, but $5 million. When did you first get involved in all this regulation crowdfunding startup stuff?
Yeah, pre-crowdfunding, because crowdfunding was the enabling regulations from the SEC was 2016. Before Regulation CF was a Regulation A plus that came into being in 2015. But before any of that, what kicked all of this off was the Jobs Act that Congress passed and President Obama signed in April of 2012. And
so that was a bit of a gap too there. What was going on that?
Huge gap because
it's 4 years. What's going on here?
Well, the SEC, particularly the chairman of the SEC, was not a friend was not a believer in crowdfunding.
I was talking to a lawyer right across the river here, actually. He's from DC. So again, this actually is not a background, folks. That is our nation's capital.
Yeah.
But he said, in relation to the increase to 5 million this week, he thought, say what you want about our former President Trump, but he thought that his guy at the SEC, they might have done 10 million. Like they really wanted to go big onto this. And the Biden administration, which kind of is an offshoot of the Obama administration, like there's a lot of overlap there with the personnel in any case. I'm not surprised by what you just said. They really want to protect the average investor.
Yeah.
And the SEC was created back in the 30s because Wall Street used to be the Wild West, man. Like, what was it? JFK's dad made all his money just basically on Wall Street scams, and they put him in charge of the SEC when they made it. So, like, anyway, but
it was the great crash of 1929 and the depression of the early 30s, and investors in the stock market jumping out of windows in Wall Street. And I think a lot of family, well, at least my family, we have stories of that.
Mm-hmm. Yeah,
of a couple of great uncles of mine who jumped out of windows because
oh my gosh,
they lost everything.
How many of them? How many uncles?
Couple.
Oh boy.
Yep. Yeah, and yeah, I mean, there are dozens of those examples. Because people were naive, they invested their entire savings in the stock market, diversification, all of these constructs that we have now as to how to protect ourselves in the stock market through diversification, through investing in other stuff, through being careful, buy and sell strategies.
Well, they let you go on margin 10-1 on stocks back then too, like all kinds of crazy things.
I wonder if they did that back then.
They did. No, you could go 10-1 in the 1920s on a stock with margin.
That is absolutely crazy. So you see what happens.
You can't. Like,
yeah.
That's the margin ratio for futures now. Like,
I know.
Yeah.
So Sean, as usual, there was an overreaction to that, right? They went completely in the other direction, and they banned, any kind of private investing, in non-public companies. The only people who could do it were professional investors, people of wealth,
accredited investors. Just it is what it is.
Yeah. So that's what the Jobs Act of 2012.
So just playing devil's advocate to the regulators there for a little bit. Technically the American public was protected from probably more than a few scams. Let's be real. But on the other hand, they missed out on a few things because the earliest investors in every company that we can think of, Facebook, Apple, Microsoft, all of them, they were accredited investors that were already rich.
Absolutely. You're not going to deny that there's a huge amount of risk in this kind of investing. On the other hand, dozens, if not hundreds, let's say hundreds of people got really, really rich from doing this kind of investing. Dozens got obscenely rich, but this kind of investing was completely blocked off from people like everyday investors, retail.
I just pulled it up here. So as of 11:34 a.m. on March 19th, Facebook stock is at $289.62, market cap of $824.74 billion. And my favorite story about what you're saying is we all saw The Social Network when the actor playing Peter Thiel invested $500,000 in Facebook for 10%.
Yeah.
500 grand, 10%. Now, obviously he got diluted, but he walked away with billions of dollars in profits, and he was already incredibly rich. He founded PayPal. Like,
well, and there's this famous story about the painter. He was painting.
Oh yeah.
Was it Google or Facebook?
It was Facebook. He took stock and he painted the wall.
Exactly. He took his payment in stock rather than cash because Mark Zuckerberg didn't have any money to give to him.
He's
and
like,
he's
I'll pay you in stock. Take as much as you want on the way out.
right. He's a millionaire now, and so this is what early investing can do. There's a great deal of risk, but if your companies catch on, if they take off, and you're just paying, at that stage, at the seed stage or pre-seed stage, or you're paying, what,
Yeah.
cent
So
on the dollar, you're going to
for
make.
our listeners that don't know, what are the stages? And then where do you think, like Peter Thiel's investment with the 500 grand for 10%, how would that translate to what we're looking at today, like in terms of stages?
Right. The stages, the
So it's pre-seed, seed.
nomenclature
Yeah,
changes a little bit, but yeah, basically, you can call the first stage pre-seed, but also you can call the first stage in terms of raising a friends and family stage,
got it.
right?
So that's
Because
not what Facebook did though, because Peter Thiel paid 500 grand for 10% that values Facebook. Oh my God, I can't believe I'm saying this. In like 2003 or whatever, 5 million. Good Lord. There's tons of companies you review every week that are worth more than 5 million. Like that's crazy.
oh yeah, that's
So
great.
would that be seed maybe?
Yeah, it sounds like a seed.
Okay.
Like that.
Because it's definitely not friends
Yeah.
and family.
But back
So
then, 2003, 5 million might have been
okay. So maybe I
might
shouldn't
have been a
throw,
post seed.
yeah.
Yeah, because a seed back then
Doesn't mean anything
might
really.
have been, between 1 and 3 mil, but
Right.
5, but yeah. So it might have been a
And we
post.
should clarify back then, folks,
Yeah.
Facebook was not making any money. And in fact, I read in Thiel's book, 0 to 1, they needed his money to buy more servers because they couldn't handle all the data. Like there was no money coming in. They needed the money for computers.
Yeah.
But anyway, so you think it's post seed, really?
Yeah, it
Like,
could have been a post seed raise
wow.
at $5 million. So yeah, so you have seed, which I like that word, the seed stage, because
We are planting
you're planting very
seeds.
early money into these very early companies, right? So seed is an apt word to describe the stage. But now it's become a little nuanced because you can have pre-seed, seed, post-seed.
Well, and the SEC also likes to clarify as well because there are regulations for each step of the way,
Yeah, that's right.
including the maximum.
Yeah. So let's keep it simple. Let's just say seed, okay, as the first stage. And so seed would be followed by Series A. And then at this point, you're just using the alphabet. Series B, Series C, Series D. So a good way of thinking of this is seed in Series A are sort of your pre-revenue or not serious revenue generation stages. Okay, and I hate to add something, a qualification to that, but I'm going to have to. The bar has been raised, right? Particularly with Series A, you really do need revenue.
You do.
As opposed to a few years ago, you might not
Yeah.
have. Now you really do, right? So Series A, you really do.
Would you say,
you,
is it because of regulations or because investors are becoming pickier?
investors are becoming pickier. Your seed, the valuations have been raised for these companies. So if you're raising at a higher valuation at
We're going to
seed,
need some revenue.
you're going to have a higher bar. Well, if instead of having a valuation of 2 mil, if you're at seed, if you're having a valuation of 10 mil, I want to see more progress. I want to see some serious revenue, even though it's still called seed, right?
Right. Yeah.
So that's what's going on right now. So the bar has been set a little higher now at each stage: seed, Series A, Series B. Everything has been set at a little higher, but series seed and Series A are considered. You're just getting revenue generation going. After Series A, Series B, Series C, Series D, that kind of thing, you're looking at the serious growth stages.
Yeah.
Right. and they're actually called, this is the growth stages.
The hockey stick part.
Yeah, the hockey stick part, the hyper growth part. Yeah, you need to see serious growth, and how you define serious growth for a startup isn't how you define it for a public company, where, if you get 20% growth for a public company, you're doing great. For a lot of the huge companies, it's even, for the McDonald's,
5% is great. That'd be
2 to 5%.
gangbusters.
For
Yeah.
McDonald's, 2 to 5% is magnificent growth for a lot of the blue chips. So 50, I would say 50 to 100% growth is considered
Year over year.
Yeah, good growth. And sometimes you have to do better than double your growth every year. And that becomes more difficult, because if you're starting off with an annual revenue of 100,000, to double that to 200,000, okay, you could do that. To double 200 to 400,000, okay, you could do that. But from 400 to 800, then from 800 to 1.6 mil, and then you're doubling that.
The first million's the hardest, as they say.
The first, yeah. I call it the law of small numbers. The smaller the number, the easier it is to show impressive growth, particularly a doubling growth.
So
as numbers get higher, it becomes more.
Let's take a step back here. So combining the increase from 1 million to 5 million to what you were just saying, like if you're gonna up your valuation and you want more money, we need to see some money on your books. There needs to be some revenues, there needs to be some progress. Do you think the increase to 5 million affects what our listeners can and should be looking for in a regulation crowdfunding?
Yeah, it will. Absolutely. The bar is going to be set that much higher now, right? Everything is going to be higher. Valuations will have to be higher, Sean, because
$5 million is.
Yeah, you can't be valuated. You can't give yourself a valuation, or your lead investor gives you a valuation of 10 mil, and you're doing a raise of 5 million, because that means you're giving away 50% of your equity, right? If you raise, right?
Nobody wants to do that unless it's at a really high valuation.
Right. So the valuations will be much higher. And if the valuations are higher, then yeah, investors will be looking for a higher level of progress, more revenue, something. So, it doesn't always have to be about the revenue too. It could be about the
patents or the product or the team,
the product lines.
Yeah.
It could be, or increasing the number of doors or stores that you're selling into. It could be, there's lots of ways to measure progress. It doesn't have to be the top line of revenue or even the bottom line of profit. But whatever the metrics are, they're going to be raised with the $5 million max now in effect since this past Monday.
So
it makes it very interesting.
For sure. I noticed that, unsurprisingly, because everybody knew this was coming, with the increase to 1 to 5 million, a lot of companies held back because they're like 1 million, 5 million. We're going to go for the 5. So we had a bunch of new raises, like way more. Our KingsCrowd's data and analyst team, they were freaking out a few days ago because how are we going to work through all these companies? Have you seen a difference with those newer companies versus even last week?
Yeah, well, they're just beginning to come in now at the 5 million, and it's just as I expected. These companies are a little further along as they should be, but also, you have to think not only in terms of their what they've achieved is further along. You're looking at their costs as well. A lot of these companies now have that are going after crowdfunding at the $5 million raise. They have higher costs because think of it. If you're raising $1 million and you have significant costs, maybe $1 million isn't just enough. So you're not going to crowdfund.
That's why a lot of companies didn't do it. Like that's actually why the 5 million increase, in my humble opinion, will really help the market, because $1 million isn't what it used to be. It's really not. I mean, think about the platforms, the seed invests, Net Capitals, Republics, they take 5%. I mean, right? Is that fair?
5 or
So you're
6%.
down 50 grand, 950. There were definitely lawyers in there, so I don't know. Call it another
Always
50.
lawyers. Always
There's
lawyers.
always lawyers. I apologize.
Getting their
So
little.
you're down to $900,000, and all of a sudden, and then you have to go through the very fun process of actually raising the million.
Right, in the marketing costs, in the marketing cost, the portal takes on some of that, but you also take on as a startup some of those costs too. So
So
that's
what would you say people
50 to
get?
100,000.
850 out of the million if they?
Yeah, I would say you're spending a good 100 up to 200. Yeah.
Between all the little middlemen and ancillary costs. So 5 million, like there have been multiple entrepreneurs that I've spoken to and read about that are just like, we wouldn't have done it for $1 million, but 5 million,
They're going to do it.
I'm interested.
Right.
But that said, there are more costs and there's more regulations. So there's even more lawyers and
Yeah, everything is going to go up a little bit more because of that.
but not as much though, like pound for pound.
Yeah, but yeah, you're raising $4 million more. So you're raising, 5x more. I don't think they're getting 5x the runway. So if they're getting a year runway with $1 million, I mean, the simple math is, well, if they're raising 5 mil, they're getting 5 years runway, but that's not how it works because they're going to have a much more ambitious growth strategy. They're going to be spending more to growing faster and getting to where they want to go sooner. That's what the $5 million gets them. And it's worth it for them because they want to, they want to make progress. They want to, carve out a piece of their market. They want to even preferably dominate their market or get a bigger head start on the wannabe startup companies coming in after them. So for all these reasons, the $5 million represents a way for them to sort of create more defensibility. And a lot of this is about defensibility because, if they succeed, if they have to stave off the competition. So
for sure,
that's a lot of it.
So now that the 5 million is here, what are 3 things that our listeners should be on the lookout for that maybe they didn't have to think about before, just to give something, actionable for people to take away here?
But they didn't have to think about
further along progress than they would have expecting. Like that's granted.
Yeah.
What else?
So sure.
I'd almost certainly like to see that they raised $1 million back in the day, right? Something.
Yeah.
I don't want to put words in your mouth. Sorry.
Yeah. I think at $1 million, you're not necessarily looking at revenue, but at $5 million, I think you have to sort of take a look at where they are in terms of revenue.
Yeah.
I mean, there's no way around that. For $5 million, you really have to look at that. Also, they're asking for $5 million rather than $1 million. So the use of proceeds becomes that much more important.
Very good point.
$5 million more.
Yeah.
There's more at stake.
Yeah. And that's on every raise. They say use of proceeds. They have the percentage breakdown. And like,
it's
that's
one thing, using part of $1 million for salary, particularly for the salary of the founder and the founding team themselves. Now, if you're using part of $5 million for salary and new hires, I'm all for. And that's what it usually
so that's
is.
a red flag. If there's a huge chunk of salaries for not new employees out of that 5 million, that's a red flag.
Another red flag is debt. Using a large part of the $5 million to pay off debt, well, that's not going toward growth. And this is all about growth.
Yeah.
So, those are.
What's more important, the use of proceeds or current financials? Because I get the impression that even a year ago, you didn't really look at financials that much with a Reg CF raise, maybe. Not that you didn't, but like,
yeah.
They don't mean the same as they do with Amazon right now. You know what I mean?
Right. I know. Yeah, I would say you have to look at both. But you bring up a good point. Is you do have to look at financials become more important at $5 million. You have to see what what their revenue is, what's going, what's floating down to the bottom line in terms of profit. When sustainability might be achieved at the $5 million raise, whereas at the $1 million raise, it could be still a little further off. So
yeah, I've been involved with KingsCrowd for going on 3 years now, and it used to be, and I don't think I'm incorrect here, a Reg CF raise $1 million. These companies be valued at 3 to 8 or something million.
yeah.
It was mostly about the product. Like I have to like the financials would be a bunch of goose eggs, and it'd be we need this money to develop the product, and really that's kind of what you were betting on at that point.
Yep.
And I don't know, after hearing what you said, it seems like that might not all the time because it's still startup land, but might be going away a little. Especially at the 5 million. They want $5 million. Like
now, $5 million, you're not you're looking at hopefully you're looking at then at not a pre-product company, but not even a MVP, a company with a minimally viable product, MVP. You're looking at a finalized product. So you really, hopefully you're looking at how the founders have not only built the product, but how they're building the company and how they're building the company for growth. And so growth, it's more of a bottom line. After I just said, it doesn't have to all be about revenue, but really, you're looking at growth metrics in a very, very serious way. When with these companies raising at a $5 million max. Because the next time they raise, they're going to be raising, $10 to $20 million, which means that valuation is going to have to be between 50 and $100
higher,
million.
I would hope,
Think about the milestones that venture capitalists will be.
They're ruthless.
They're
ruthless.
It's going to be quite high.
Yeah.
And,
they're going to want board seats.
Yeah. And yes, and crowdfunders do not want a down round, so it's going to be very interesting. It's almost,
I can't wait. The next year is going to be amazing to watch.
Yeah. These $5 million, in a way, you're sort of betwixt, you're not, 5 million is a lot, but it's not, remember, under crowdfunding regulation A+, you can raise up to $50 million in some cases. In other cases, easily up to.
It was 75. There was is that Reg A or is it
That's Reg A.
Yeah, Reg A 7. Yeah.
Wow. Reg A. So this is not entirely different, what CF is doing, but CF is quicker, it's faster, it's a little cheaper. I think it's going to attract more companies than
For sure.
Yeah.
Very good, sir. Will you get the last word? Do you want to give a shout out to your grandson? Do you want to plug early investing? Do you want
to?
Who's going to win the March Madness? I don't know.
Oh, I don't. Yeah, I'm not going to because I'm all about research. That's what we do in companies, and I haven't done enough research into.
I gotcha.
Into that to do that, but I would say that there's going to be a raft of new companies raising, and there's going to be a lot of great companies. So I think this is the point that I want to make. It's not only more companies moving into the crowdfunding space attracted by the $5 million max now. I think there's legitimately going to be better deal flow.
For sure. Because it's worth their time now, right?
Yeah, absolutely. Yeah. And these are companies that would have been seeking VC money that will now be seeking crowdfunding money. So that's a great
huge
thing.
Deal. Yeah.
But I would say now more than ever, do your research. And that's what we do. That's what early investing does. We do 100% independent research into companies.
You guys talk to managements all the time, I've noticed.
Yeah, multiple.
In fact, that's when I first met you. You guys were visiting some guys in Boston, I think, wasn't it?
We have a few Boston-based startups in our portfolio, but they come from all around the country. That's the great thing about our portfolio, about crowdfunding. It's not just West Coast Silicon-based companies. They come from everywhere. And it's funny, a couple of the companies that I've invested in, they're like a 5-minute drive away from me. Just serendipity. They happen to be,
Yeah.
if it wasn't for
Up there in Baltimore?
I would have been talking to them up in Baltimore.
Wow. All right.
And now
Baltimore's the new Silicon Valley.
Yeah, there's a founder now I'm talking to. He's a professor at Johns Hopkins,
Oh, wow.
a Maryland company. I'm in Maryland.
Pharmaceutical, I have to say. Yes.
So this is the first time I'm asking the founder, can we meet? So in my email it says, well, I'm fully vaccinated. Are you? So this is sort of different. I wasn't asking you anything about vaccinations before.
It's a weird world.
Weird world, yeah. So this is what we do: multiple conversations with founders, really, asking them tough questions because what's on the raise page, it's a lot of positive spin. I'm not saying that they're not being dishonest, but it's, they emphasize
you have to put your best foot forward, as in all things.
Yeah, so it's up to me to sort of tease out, some of the risk involved in and some of the possible negativities that these companies may have, and don't necessarily want their investors or prospective investors to know. But it's a great job. You would probably, instead of writing about this stuff, would you prefer spending all your time talking to these companies rather than writing about these companies?
You learn things.
I don't know. Maybe we could do a trade one of these days for
interesting. That's after COVID.
After COVID, everything
this summer. Fingers crossed.
Yeah, this summer/fall. Yeah.
Very cool. Well, Andy, thank you for your time. It is always a pleasure. And we'll have to dig into more of the VC world, how they usually operate next time.
So much to talk about, Sean.
Yeah. For sure. And once again, congratulations on the birth of Samuel.
Thank you. Appreciate it.
And that is it for us, folks. If you have any questions about the online private markets or KingsCrowd's proprietary ratings and analytics platform, Merlin, just email us at podcast@kingscrowd.com. For Andy Gordon, I am Sean O'Reilly. Thanks.